Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name's Michael, and this week we'll be discussing bubble concerns, sector rotation, and tariff tactics. The market is taking a hit, and everyone is pointing fingers at the escalating trade war. Tariffs are grabbing headlines, GDP forecasts are sinking, and investors are feeling uneasy. But here's the thing, there's more to the story than just tariffs. Beneath the surface, valuations and earnings are raising some serious red flags. So today, we're diving into what's really driving the market's latest moves, how valuations fit into the bigger picture of growth, inflation, and interest rates, and why this isn't just a US problem, it's a global one. Before we get into that though, here's our quote of the week. In any diversified portfolio, there will be both winners and losers, and the consideration that should determine which you should sell, if any, is certainly not the price at which you bought it originally. And that quote is from Daniel Kahneman. Now let's do a quick recap of what happened in markets this week. Firstly, defense stocks are soaring in Europe. With US military aid to Ukraine on pause, Europe is ramping up defense spending. Germany is leading the charge, and the EU just rolled out an $840 billion military modernization plan. That sent stocks like Leonardo, Thales, and Rheinmetall surging as investors bet on long-term demand in the arms sector. Elsewhere, coal stock is in freefall. The retailer slashed its dividend and warned of weaker sales, sending shares down 20%. Lower-income shoppers are pulling back, and despite an earnings beat, guidance for 2025 is looking grim. Coles isn't alone. Retailers reliant on discretionary spending are in for a rough ride. Elsewhere, you've got Europe firing back at Trump's tariffs. The EU is hitting back with counter-tariffs on $28 billion worth of US goods in response to Trump's 25% steel and aluminium tariffs. Markets are rattled as investors worry about supply chain disruptions and rising costs. And if Trump doubles down on his reciprocal tariff stance, things could get even messier. In other news, Adobe investors aren't thrilled. The company met revenue expectations, but dropped 4% in extended trading hours as concerns over AI monetization grow. Adobe says AI-related revenue will double by year-end, but Wall Street wants results sooner. Right now, expectations might just be getting ahead of reality. Next up, Intel is shaking things up. The struggling chip giant brought in Lip-Bu Tan as CEO, sending shares up 12%. Investors are hopeful he can turn things around and help compete in AI against Nvidia. But a leadership change alone won't be enough. Intel needs results, and fast. And lastly, corporate travel is slowing and airlines are feeling the pain. Delta slashed its profit forecast, blaming, quote, consumer and corporate confidence issues, sending airline stocks down. When businesses cut travel budgets, it's often a sign of broader economic belt-tightening. This could be a canary in the coal mine for job security and economic conditions ahead. Now let's get into the main piece. Trump tariffs, tech valuations, and market bubbles. Earlier this year, Bank of America warned that US growth stocks were deep into bubble territory. One of their key indicators? The ratio of US companies' market caps compared to non-US companies hit 3.3 standard deviations above its long-run average, which is well beyond previous bubbles of the 1960s and 1990s. The report suggested that if the bubble bursts, the S&P 500 could tumble 40%. While they weren't predicting an imminent crash, they were warning that valuations were getting risky. So far, market moves haven't been driven by a valuation reset, but uncertainty from tariffs and weaker consumer spending has spooked investors. When risk appetite disappears, it's always the hot money stocks that get hit first and hardest. So now let's talk about passive investing's role in this market structure. Another factor of today's conditions is the rise of passive investing. Unlike in the past, when active managers pick stocks based on valuations and growth, today's market sees massive inflows into ETFs that automatically allocate funds to the biggest names. That helps the winners keep winning, but could also mean we're overlooking potential risks. Right now, the market is optimistically priced, with the S&P 500 average PE ratio sitting right at its 10-year average of 28.4. Tech stocks, though, are another story, trading at 41.8 times earnings, which is well above their 10-year average of 33.3. Is it a bubble? Maybe. But here's the counter-argument. Tech giants like Microsoft and Alphabet are far more profitable and less capital-intensive than past market leaders. And if AI delivers on its promise, growth could accelerate in a way that justifies today's valuations. On balance then, it's probably fair to say that there is a lot riding on the success of the AI trade. So let's talk about the earnings season that's now wrapping up. Is this a reality check? Earnings season started off fine, but warnings from retailers and airlines suggest consumer demand is softening. Analyst estimates for Q1 earnings have already been cut by 3.5%, and it's looking like we could see the first quarterly earnings decline in 5 quarters. Investors want proof that AI investments are paying off. Hyperscalers have built the infrastructure, but now it's time for the applications to generate revenue. So far, Adobe and Salesforce have left investors unimpressed. Will that change? Well, we'll just have to wait and see. Now let's move on to Trump and the tariffs. What is Trump really trying to do with these tariffs? Trump's aggressive trade policies are puzzling and theories abound. Some believe he's pushing trade partners into a corner to force better deals for the US. Others think he's deliberately resetting the economy, potentially even orchestrating a recession to force the Fed to cut rates. But it's anyone's guess. If a financial crisis or bear market forces rate cuts, it could help the US refinance its debt, weaken the dollar, which makes exports more competitive, and even reset the housing market to improve affordability. But it would come at the cost of short-term economic pain. So let's talk about what's known as the Fed put, the Trump put, and this market volatility. Some analysts believe Trump will reverse course if markets fall too far, the so-called Trump put. Meanwhile, the Fed put implies the central bank will step in with rate cuts if things get too bad. With the S&P 500 down around 10%, neither has blinked. Maybe the magic number is 20%, or maybe this time they'll let markets sort themselves out. So, what's the insight here? There's more than one way to diversify. Uncertainty is high, but that doesn't mean investors are out of options. Now might be the time for underperforming sectors to shine. Diversification is key, but not all diversification is created equal. Avoid these 2 traps. 1. Owning a diversified portfolio where everything is exposed to the same risks. And secondly, using diversification as an excuse to invest in mediocre ideas. Instead, think about diversification beyond just stocks. What about regions and countries? Don't put all your eggs in one market. As for sectors and industries, AI and tech are hot, but what else is in your portfolio? Then there's currencies. USD strength or weakness can impact returns. Then there's inflation and interest rates. Some assets thrive in high inflation while others crumble. And lastly, energy prices. They are a key driver in market cycles. At the end of the day, it's all about knowing what you own and why you own it. That's where tools like Simply Wall Street can help. If you want to see how your portfolio stacks up in terms of its diversification and strengths and weaknesses, check out the portfolio tool on the platform. You can link to your broker, import transactions, or explore our demo portfolio to see what's on offer. And that's it for this week's Market Insights. To get a much more in-depth written breakdown of this week's insights, check out the link in the description, which will take you to the article. But we'll be back next week with more insights. Until then, invest well.